Orman Wilson, certified public accountant with the firm JamisonMoneyFarmer. He focuses on providing estate tax planning and compliance services primarily to trust clients. With more than 22 years of experience in public accounting, he also assists clients with corporate, partnership, and individual income tax return reporting. He is past president of the Tuscaloosa chapter of the Alabama Society of Certified Public Accountants. And Orman, we appreciate you coming and sharing with us today on how we can cut our tax bill.
I know you're looking forward to hearing from me, not because I'm good, but because I'm the last one, and then you'll get your door prizes and get to go home. But as he said, I'm Orman Wilson. I'm a CPA from Tuscaloosa, Alabama. I have my associate, Scott Graham, in the back. Throw your hand up so they know who you are. We actually have a timber practice group in our firm. I happen to be the chairman of it at this time. When Lee contacted me, he said, hey, I'd love for you to come speak to the AFOA about cutting taxes. And I said, hey, Lee, that sounds great. When do you want me to come? He said, well, you could set up April 16th and talk April 17th. And I thought, oh, my God, April 15th is the deadline. You know, I'll be a zombie walking around here. But I love this group. I know y'all love your timberland, and I just could not pass up the opportunity to come speak to you. Now, normally, I'll do an hour presentation on strictly timber taxation, okay? That's not what this is about today. This is just going to be a whole hodgepodge of ways to cut and save taxes for your 24 return and your 25 return. Is there anyone in here who says, dang, I wish I could write a bigger check to the government when you file, because you don't need to stay in here. Okay, I didn't see any hands. Second thing, is there anyone from the IRS in here? Hey, you got to raise your hand if you are. It's like asking somebody, are you a policeman? You got to identify yourself. Okay, all right. Now, let's talk about ways to save taxes, all right? First, and I'm only going to talk about legal tax deductions. I did have a client call me that said, hey, I want you to do this. And I said, yeah, I can't do that. He was like, why? And I said, it will cost me my license. He goes, I'll never ask you to do anything like that again. All right, 401k or IRA contributions. There's some people in here who still are eligible to put money into a 401k or an IRA. Maybe you're self-employed and you got a Schedule C. You can make a SEP contribution that also reduces your tax liability. Home business costs. You'd be surprised at the number of people who work at home these days since COVID. Yes, and you can deduct a certain percentage of your utilities, phone bill, insurance, depending on how large your home office is. But be careful, it needs to be a home office. It doesn't need to be your den where you go in there and watch Netflix, you know, at 5 p.m. at night or whatever. It needs to be a dedicated home office. And some education-related expenses. You may be paying to send a daughter or granddaughter to college. We've got education credits for that. All right, property taxes and fees. When the Tax Cuts and Jobs Act was passed, it basically nullified these deductions because the standard deduction was raised so high that most of the time people do not itemize anymore. Well, you've got property taxes that you're losing. You got a Schedule E, you got a Schedule F. Put your property taxes on these schedules and you will get a benefit from it, even if you don't itemize on your return. All right, accounting fees, which I'm real partial to. I love all of those. Legal fees. These are now no longer allowed on your federal income tax return. Well, you've got rental property on E, you've got a farm on Schedule F, you pay your accountant to do your taxes, you got an attorney that's done some work for you, put those fees on those schedules and go ahead and get some benefit out of them. All right, required minimum distributions. The new age is 73. All right, if you've already been required to start taking your RMDs, you can't say, well, wait, I'm going to wait till 73 to take my next one. It's taxable upon distribution, and it's taxed at whatever your current tax rate is. Now, most people put money into an IRA or a 401k when they were in the 22, 28%, 33% bracket, so that when they draw, and it was tax deferred, so that when they start drawing it out, well, you know, they may be in the 15% bracket or the 20% bracket, but it's saving them tax money that way. Now, if you don't want to report it at all, you could do what's called, well, first off, charitable contributions. The Tax Cuts and Jobs Act, it's up to 60% of whatever your adjusted gross income is. Cash is good. I'm on the board of Big Brothers Big Sisters of West Alabama. We never turn down a cash donation. It helps us process. Non-cash is also good. Nonprofits are not going to turn down donations. If it's more than $500 of whatever, clothing, a boat, whatever, if it's less than $500, you don't have, you just fill out Part A. If it's more than $500 but less than $5,000, you fill out Part A on the 8283. If it's more than $5,000, you'll have to get someone from the nonprofit to sign the Form 8283 saying how much it is. Now, I had a client once who wanted to give a boat, and this was like a $200,000 boat. He wanted to give it to a charity because a friend of his who happened to be getting his hair cut at the same time as him said, hey, I donated my old boat to the charity. I got a $100,000 charitable contribution. So my client said, hey, I think I'm going to donate my $200,000 boat to the charity. And I said, be careful, because it may be a $200,000 boat, but if they turn around and sell it for $100, your deduction is $100. It's whatever they got for the boat. Now, low basis stock. It is an excellent, excellent charitable contribution. And I'll give you an example. Let's say you own Region stock, and it's just been passed down to you. You got $1 per share is your cost basis. And to make it simple, let's say it's $100 a share. Now, I know it's not that much, but you can sell $10,000 of Region stock, donate it to the charity. Well, that's fine, but you got to report $99,000 worth of capital gain. I mean, $9,999 of capital gain. Okay, now, you can gift the same stock to the charity. You get the $10,000 charitable contribution, but you don't have to report capital gains. So keep that in mind. If you've got some low basis stock and you don't like paying capital gains tax, the charity will take it. All right, yeah, and like I said, the nonprofit benefits either way. They're going to get your $10,000 cash, or you're going to give them the stock and they're going to sell it and then get the $10,000. Okay, now I know I'm just wide open. If anybody's got any questions, throw your hand up. All right, QCDs. I've got a few clients who, instead of getting their RMDs from their mortgage people, from their investment people, they just have their required minimum distribution sent straight to a charity, either to the church or to Big Brothers Big Sisters. Just make sure that the investment people do code your 1099-R as being a QCD. Because if not, it will be reported as the IRS will be looking for it on your tax return. Now, this isn't just wonderful. You don't have to report the income, but you also don't get the charitable deduction for doing this. But it's still works out better for you. All right, mileage rates. 67 cents a mile now for 2024. And I've got clients who say, well, you know, my family farm's only 50 miles away and I only go over there once or twice a week to check on it. Well, you think about it, that's 100 miles round trip, once or twice a week, 200 miles a week, 52 weeks a year. That adds up, and it's 67 cents a mile. That's a pretty good deduction.
Sir,
Yes.
from his house to the farm and back.
He's going to,
Principal place distance.
yeah, but he's going to check on his farm, on his timberland, which is a business. It's his timber business. So he's going to check on it.
You can do that.
Oh, yeah. Now, keep a log, you know, just write down, you know, January 2nd, drove to family farm and back, 100 miles. You know, April 2nd, whatever, drove to family farm. And it wouldn't even hurt to say, you know, check the fencing, check, you know, water quality, whatever, kind of describe what you did while you were there. So the IRS doesn't know you're just driving over there, turn around, coming back, so you can deduct 67 cents a mile. So now, in 2025, the mileage rate went up $0.015 per mile. We don't know what this will be until December when they announce it. But I don't, as long as inflation is kind of holding, I do not see it dropping. All right, now, you don't like paying taxes. Well, you can defer them. You've got some real property that you want to sell it, do a 1031 exchange, and you defer the tax. Now, there's some stipulations. You can't just go out there and sell it and hold the money and all. You need to use an intermediary. I had a client call me once and said, Orman, I've done a 1031 exchange. I got rid of the family farm, and let's just call him Joe. I said, well, Joe, be careful, because there's all kinds of rules, regulations, and he goes, oh, I know. He said, I've already put the check in a savings account at the bank. And I said, well, okay, Joe, I got bad news for you. You're not doing a 1031 exchange. You can't touch the money. You have to use an intermediary, and you have to identify replacement property, and you have to reinvest the money you got into this new property. Now, that's good. You recognize no gain on sale. Problem with that is your basis in the new property is whatever your basis was in the old property. But you know what? You don't have to deal with it until you sell it later. And your children won't have to deal with it if you die before you sell it, because then you'll get a step up in basis, which I'll talk about in a minute. But 1031 exchanges, you could trade a bulldozer for a motor grader. You know, not anymore. It's got to be real estate, real property. Carryover basis that you never have to worry about unless you finally sell the replacement property. And it's deferred tax. Everybody loves deferred tax. There's a $500,000 limit. So, I mean, you know, if you sell something and you would have had more than the $500,000 gain on the sale, the IRS is only going to let you defer the $500,000 up to $500,000. You'll have to pay capital gains on whatever else you have. No, it's $500,000 per exchange.
Is that per person or per year or?
Yes, per exchange. I guess you could do 10 exchanges, but it's $500,000 per person per exchange.
If the property is owned, the deed is like husband and wife, is it $1 million limit for that couple, or?
Depending on who your CPA is, I could say yes. So, and all right, let's speak of that. You never really want to do anything that's just going to slap the IRS in the face, because the last thing you want to do is get a letter from the IRS. Oh, and speaking of that, they never call. If you ever get a call from the IRS wanting you to do something because you didn't do something, just say, okay, I'll get right on it, and you can just hang up. They never call anybody. But I was attending a seminar in Nashville, and I told somebody in the audience, I can't remember who it was, but this retired IRS agent said, I want to debunk a myth. People are scared to death to extend their returns. They just think that's telling the IRS, hey, I'm sneaky, I'm doing something I shouldn't be doing, so I'm just going to extend so you'll forget me. She said, if you extend, you're much less likely to ever be audited. She said, now there's a chance, but it's much less because the IRS has millions of tax returns filed by April 15th. They have to plan their year based on the returns that have been filed. So that's when they're picking returns to go audit for the rest of the year. Now, slim chance, not no chance, but a slim chance. Oh, no, I only got 5 minutes. Now, you can do a 1033 exchange. You got I heard someone talking about pine beetle damage. Sell it, and you've got 2 years to reinvest the money, and you don't have to recognize the gain. Any natural disaster, not just pine beetles or storm damage. 2-year investment window. And it's got to be at least as much as the replacement property's got to be just as much as what you sold. All right, here we go. I know this interests everybody. Do you have a forestry management plan? It's very important that you do because you can either be a timber investor or a timber business. There's also like hobby and personal use, which we're not really worried about that. But if you've got a timber business plan, it shows the IRS you have a profit motive and it allows you to do more. You can deduct more expenses, and that's the 2 most favorable tax classifications for timber owners. Now, 631B election. I probably got just enough time to end this. And some of you have heard this story. I was sitting at my desk April 14th, 2016. My phone rings. It's like 3:30 in the afternoon. It's a guy who owns 30,000 acres of timberland. He was like, do you know much about timber tax? And I said, well, I know a pretty good bit. What's going on? And he said, well, my CPA knows absolutely nothing about timber. And said, I just filed my tax return and I paid $800,000 in tax on $2 million worth of timber proceeds. And I said, well, you're in the timber business, right? And he goes, yes. And I said, well, if I was your CPA, I said, I would have treated the timber sales subject to the 631B election. I said, that would have reported them on Form 4797. I said, and it treats them as ordinary income. Therefore, it's not subject to the net investment income tax, which was 3.8%. I said, but the beauty of it is it gets taxed on Schedule D, and in this case, at the 20% rate, because it was $2 million worth of gain. Now, that saved him $400,000 in tax. And he said, will you be my CPA? And I said, hey, I can become your CPA, but I said, tomorrow is the tax deadline. And he goes, oh yeah, I understand. He said, I filed my return today, and he said, I started calling CPAs. He said, you're the 6th one I call, okay? I told my business manager, and he Googled accounting firms timber tax. Lo and behold, we were the 6th firm listed. I guarantee you, with it being April 14th, he had called the first 5, and none of them would give him the time of day. And I took the time to actually talk to him and answer some of his questions. And to this day, he is still my client. And I've only got 1 minute to go. There's the 631B. I was going to talk about estate. Let's talk about reforestation. $10,000 per site. You can have 10 sites, $100,000. You can deduct anything over. You got to amortize it over 84 months. Not the best in the world, but Alabama does not allow reforestation, so make sure your accountant keeps up with your reforestation expense because it's added to basis as far as Alabama's concerned. You recoup that whenever you sell your timber. Okay, potential gains, this is never going to happen. Congress is like, no more capital gains. We're just going to treat everything as ordinary income. Yeah, I don't think that'll fly because you know why? They like getting reelected. And if they ever enact this, that'll probably be their last term. Okay, y'all have already talked about bases, and I have been told to stop. So I tell you what, I will be here. I can't believe time just flies when you're having fun. Anyway, I'll be here for a few minutes, so if you've got any questions, just let me know. And if you want a copy of my slide presentation, the other 30 or 40 slides, I can email them to you. Thank you.